Hey everyone, welcome back to another edition of Superprime UK with your Superprime valuation specialist, myself, Rob Cohen.
And myself, James Wild.
Hope you're all well. Super jam-packed week of data, intel, market updates, huge volatility and uncertainty. And here we are this week to share with you everything that's happening in this fast-paced, fast-moving market. James, what you got for us?
Thanks, Rob. So we're going to start with the data this week again. So, Rob, it's been quite a disruptive few weeks in terms of the Easter break we had, and obviously we had the May Day bank holiday last week, so another short 4-day week. However, the data for last week we have new instructions are hovering around they're at 293, so that's about average what we've seen this year. So pretty positive there. And the sold figures, Rob, have actually recovered. We're at 146 for last week, despite it being a fairly short four-day week for the agency offices. So I think that's quite positive, returning to that sort of medium average which we've seen for 2022, 146 this week. Under offer again, good pipeline of deals there at 277 this week. So that'll hopefully bring through in the coming weeks sold figures of around the sort of median averages which we've seen for the year.
Yeah, activity is still busy, although conditions are coming under pressure because of the wider macroeconomic policies and conditions we're facing, to which we're going to touch on now.
Yeah, thanks, Rob. So, I mean, if we cast back our minds just the start of the year, the UK economy was starting to leave the sort of worst effects of the pandemic behind, despite a threat from the Omicron variant, which we're seeing in the UK. However, we've now got a situation where we're facing a peak inflation at the end of the year of 10%, which is being forecast, a significant increase on the forecasts. Takes back to October 21, the forecasts were only about 4% for that period, so a significant uptick there. Furthermore, the Bank of England just at the end of last week announced that it is anticipating at least 1 quarter of negative GDP growth for this year in 2022. What they've cited there is they've cited a squeeze on our living standards driven primarily by the soaring energy prices that are set to possibly further intensify, Rob. And obviously if we do get a second quarter of negative economic growth, it would trigger another recession. However, if that were to come, that would be more likely to be 2023.
Yeah, a real crossroads now with UK economic policy, and obviously the information coming through from the Bank of England, especially following their interest rate increase. And the government have responded, and the Prime Minister has responded with the hope to spend their way out of this situation with wage growth and spending power to rebuttal those uncertain economic conditions that we're facing. So it's going to be a really key 6 months for UK fiscal policy, to which we're going to face a real crossroads, and we're really going to have to keep an eye on what's going on, and it's changing week by week, which is what's so fascinating about the markets. Again, lots of uncertainty, lots of volatility, lots of macro and micro information being fed into all the systems, and it's going to be a critical period to see what the government do and how they act to all the pressures that they're facing.
Yeah, I mean, I think the autumn budget this year is going to be absolutely massive, obviously coming before winter, with obviously energy prices being what they are and possible further increases as we move through the year. Whether there'll be any government changes to their policy or spending or incentive schemes that they may release, we'll see if any get released before that autumn budget. Just want to move on to the mortgage market and rates. Obviously, if we start off at sort of entry level of the market, Rob, last year, April 21, we had the new scheme of 95% government-backed mortgages which came in. So around 12 months on now. I just thought we'd have a quick review of how that's gone so far. So particularly active Q4 last year in that sector. And just to give you an idea, the 6-month period from its launch April 21 to September 21, there was about 6,500 deals in that space of 95% mortgages. However, in the period from October 21 to December, there was just under 5,900 deals. So more or less the same in half that period of time. So I think availability, Rob, of mortgage products coming more online into the market has obviously influenced that. There's more deals in there for the consumer market. And just a little bit of analysis there. 86% of those were first-time buyers, with that scheme not only being eligible for first-time buyers, but those moving within the property ladder as well.
I think it's a key element of the current government's policy and campaign to push first-time buyers through into the market and use that platform of the 95% to improve economic conditions, enhance the economy in general. So I think that will be an area that government will really continue to push and hope that there is more activity in line with what you've just shared.
Yeah, thanks, Rob. And just wanted to give you a more live update. I mean, like I say, Rob, the last few years, everyone's on a 2-year fixed, a 5-year fixed mortgage. Those are the really hot mortgage products, and that's what caused the real rate war, which we saw in 2021 last year, wasn't it? So the average of the keenest, the low LTVs, those 50-60% LTV deals on 2-year fixed and 5-year fixed rates from the top 10 lenders in the market. Now these are both above 2% now. So the average for a 2-year fixed on a low LTV is now 2.36%, Rob, and respectively for a 5-year fixed low LTV, that's 50-60% LTV, is 2.46%. So that is a significant rise. We saw historic lows last year. We were bringing you weekly updates on the rate wars from everyone in that sector in the market. I mean, the historic lows were about, we had about 0.83% for the 2-year fix and about 1.05% for the 5-year fix last year. So those have more than doubled.
Yeah, I think it's a fascinating space. Everyone's watching, listening, especially in the mortgage marketplace and the lending and banking industry. This space is fascinating now. Everyone is jockeying for position, and that's what we've seen in April coming into May. It was a race for space in terms of the property market, and that still has legs to run because there's still a lack of supply and still a huge demand for that space that hasn't been occupied yet by those purchasers looking for the larger footprint. Now, from a race to space, we've got a race for rates, and that's what's intensified over the last few months. As like we've heard from James that there's been an increment in those rates, and the banks now are uncertain because of the economic conditions we're facing and the volatility that we're facing, especially with the huge inflationary pressures. They don't want to be out there with the best product, and so everyone is jockeying over the last 4 or 5 weeks, pulling rates, putting in new products, understanding where the market is. And I think we're really going to have to watch this now on a literally a weekly basis. And I think it's just a fascinating position, the relationship with how the market is performing, the demand and supply equilibrium of that product on the market, and then the mortgage market, both with refinance and for new acquisitions, with the different levels of LTV coveraging. It's just fascinating, James, and I think that's going to be a key point of our intel and data and conversations in the weeks moving forward, because it's got to a point now where it has a huge effect on all markets.
Definitely, and we've had 4 consecutive incremental increases, Rob, in that base rate. So the market's been scrambling in terms of deals. Just the sort of getting a new product out there is almost being readapted and pushed back into the market. So it's such a short space of time which this has happened.
Yeah, absolutely.
On the last show that I was present at, we spoke a lot about what a bumper year 2021 was in the residential market. So I just wanted to expand on that a little with some more data, Rob, as we didn't have the stats at our fingertips at that point in time. So over 1 million houses were sold in 2021, a phenomenal number. We spoke about it being a record-breaking year in terms of transaction volumes. An average price of about 260,000 there for that year alone. And in terms of the monetary amount being spent, £260.5 billion on dwellings. On a monetary basis, that is 37% higher as compared to the year 2020. So it just shows what an uptick there was in that period. And let's not forget, the second half of 2020 was a very hot market in the residential sector, just coming out of that sort of bottleneck of lockdowns. And it really built on that second half of 2020 there.
Yeah, and 2022 has started extremely strongly, and the first 4 or 5 months will show good, robust performance. And then I think the question mark, as we keep discussing, is where is the sustainability and does the market have legs? And that is now coming under a lot of pressure as the market could be seen to soften due to the impact of the inflationary pressures and the borrowing impact on mortgage rates and affordability changing on a daily basis with the new modelling coming into place. So I think it would be surprising if the highs of 21 in terms of volume are matched, even though 2022 has started strongly with robust numbers. The economic data that's coming out, along with the borrowing position in terms of affordability, is naturally going to have an effect, call the market, and we'll have to see what the volume looks like over the coming months.
That's it. I think a little bit of heat has been taken out of the market by some of the economic news which we're hearing. And also in terms of some of the asking prices, Rob, we're not seeing some of those outliers in terms of those asking prices. There are a lot more sensible levels now, a lot of the asking prices. A lot of things are more sort of price to sell. We're not seeing quite as many, or certainly the pool of purchasers. There's not any more of those sort of 30, 40 people per property. I think that's slightly lowered. Even though the market is still performing very well, there has been a slight cooling over the last month or so.
Yeah, absolutely. The agents that we're speaking with have said that that's softened, and that peak demand for that product that wasn't out there has softened for the reasons that we've just mentioned.
Thanks, Rob. Also very topical this week, we've had the planning reforms. The government has sort of addressed that this week, whereby the current scheme will be that people will be able to vote on property extensions in their area as part of these new planning reforms, so the government says. I just wanted to get your thoughts on that, Rob. Obviously, in London, I would say that there's a bit more of a pro-development psyche amongst people. People are very keen to sort of build out, expand houses, whereas in the rural areas, people are a little bit more sensitive and a bit more protective mindset of the housing there. Just wanted to get your thoughts on if you think, that particular scheme is going to work on the planning reforms.
Yeah, I think it's a real challenge. I think the government are under pressure because one of their campaign promises was to build with more updated planning reforms, which, are a bit old-fashioned in the UK to say the least. So they want technology to come in to improve planning, quicker approvals where available. And so for the government to reach its campaign promises of 300,000 properties, they do need as flexible planning policy as possible. And so they're caught really between disappointed constituents in maybe some of those more rural locations that don't want to see the changes, and then the flip side in the locations where development is ripe and ready, the more laborious and red tape bureaucratic processes that have been in place need changing. So I think they're in a difficult position, but ultimately there is a shortage of housing in this country, and the government have made strong promises that reforms will come into place to ensure that that target is met. And I do think the government will do everything they can to meet the targets.
So, like you said, Rob, there on a macro level, the target is by mid 2020s is 300,000 properties per year get delivered. I think pre-pandemic it was about 245,000, and obviously during the pandemic we got hit, and I think we delivered about 220,000. So that fell back. So we're going to see how the next year goes in terms of if they get a clear run, whether they're near that target of 300,000. On a more micro level, on those planning reforms, I think, with the neighbours and people voting on sort of if someone's allowed planning permission to extend, I think if there will be an appeal process set about, whereas if you've got a policy compliant extension or scheme which you want to build out, you would still be able to do that, but it would be more on an appeal basis, as there'll be the sort of planning structure in place which will sit sort of behind the scenes there.
Absolutely. Just to wrap up this week's show, so much has happened in the last week. It is really, really an amazing marketplace currently, with so much volatility and uncertainty. And I've repeated a million times on this show, uncertainty is the new certainty without question. Uncertainty is the new certainty. And moving forward in 2021, each week a different dynamic in macro, microeconomic and fiscal policy is going to be thrown at us, so that when we're sharing you all the latest data and intel and updates from the property and lending markets, we'll see that come into play and see how that affects us. So it's going to be a very fast moving piece, and we're here to share that with you. Brilliant intel, brilliant data. Great to have you back, James. And great to have you, the audience, and your support. Brilliant figures, both on the podcast, which I strongly recommend if you want to catch up, listen to every week, on YouTube and all the other socials. Great engagement and great interaction. And we're going to need you more than ever on this journey over the next 6-month period. And I can assure you that James and myself will be here to support you with your market needs, requirements, data and intel as we venture into some highly volatile and highly uncertain market conditions. Great to have you back, and we will see you all next week. Take care, everyone. Thanks, James.
Thanks, Rob. Thanks very much, everyone.